You've likely heard it from your parents, your teachers, and traditional financial advisors. The ultimate finish line for the American dream is owning your home outright, free and clear. To be clear, not all debt is the same. If you have a credit card charging you 25% interest for a pair of designer sneakers, you need to wipe that out immediately. But a 30-year fixed-rate mortgage locked in at 3% or 4%, that is a different financial instrument entirely. Yet the moment millions of people get a year-end bonus or save up a little extra cash, their first instinct is to dump every spare cent into overpaying that mortgage. They want the peace of mind that comes with being completely debt-free. Here is the problem with that logic. If you hold a mortgage locked in at historically cheap rates, rushing to pay it off creates a mathematical disadvantage that limits your future net worth. By prioritizing a debt-free status above all else, you are committing your most flexible resource to a single, static asset. This path creates a ceiling on your financial growth that often goes unnoticed for decades. The modern institutional banking system is incredibly profitable, and they rely on the public misunderstanding how money works over long periods of time. This chart shows the baseline rate of inflation. At a normal rate of about 2.5% a year, the purchasing power of a dollar steadily drops. Over a 20 or 30-year timeline, cash simply loses massive purchasing power. But look at what happens to a fixed mortgage. As your cash loses value, the real cost of that fixed debt shrinks right alongside it. If your monthly payment is locked at $1,500, it stays exactly at $1,500 for 3 decades. Meanwhile, wages, groceries, and cars steadily increase in price around it. Why would you take today's highly valuable cash and urgently throw it at a debt that is guaranteed to cost you less in the future? Inflation is an automatic debt eraser. When you overpay a low-interest mortgage, you are voluntarily rescuing the bank from the negative effects of inflation and taking the loss yourself. When you aggressively overpay your mortgage, you take liquid cash and trap it inside 4 walls and a roof. That money is now completely locked away and illiquid. You cannot easily access it to start a business, handle an emergency, or generate new income. This bar chart shows exactly what happens to your return on investment. If you throw an extra $1,000 a month at a 3% mortgage, your absolute maximum financial benefit is capped at that exact 3% savings. Now compare that to the broader stock market. Over the last century, an index fund tracking the S&P 500, a collection of the 500 largest publicly traded companies in the U.S., has yielded an average annual return of roughly 10%. When that gap between a 3% savings and a 10% compounding return stretches out over 30 years, the math becomes staggering. This is your opportunity cost. By choosing the perceived safety of a paid-off house, you are forfeiting hundreds of thousands of dollars in compounding growth. That emotional desire to hold a mortgage-free deed directly funds the loss of your true financial independence. You stay running on the hamster wheel to save pennies while sacrificing dollars. You don't need access to complex institutional banking to fix this. Modern investing mechanics have made wealth generation highly accessible to the middle class. This graphic illustrates fractional shares. Instead of needing thousands of dollars to buy a single expensive stock, you can buy tiny, affordable pieces of it. This eliminates the barrier to capturing that historical 10% market return. The logic relies on a dual-track approach, allowing inflation to slowly devalue the fixed debt you owe, while using your surplus cash to capture the growth of the broader market. You are essentially letting time do the work on both sides of your balance sheet. Here is the specific step to take today. Log into your bank, cancel your recurring mortgage overpayment, and set up an automatic transfer of that exact amount into a tax-advantaged retirement account or a basic index fund. By letting the bank absorb the cost of inflation while you capture the growth of the broader economy, the math shifts in your favor. This turns a standard mortgage from a burden into a tool for compounding capital.